Good afternoon, dear friends. Today, I would like to talk to you about a very important topic. Every time the Canadian Central Bank changes the interest rate, we get a lot of questions because our clients who have been pre-approved or who haven't physically moved into their homes yet, we always tell them that when the rate goes down, there's no need to worry. We'll automatically give you a better rate. We can even transfer you from Bank A to Bank B because we're not tied to any bank, and it's not in our interest for you to be paying a higher rate. But if the rate goes up, there's no need to worry because we've locked it in for you, and it can only go down, not up. After the last decrease and after every rate change, we always get calls from clients asking what's happening with their rate. But if the rate goes up, there's no need to worry because we've locked it in for you, and it can only go down, not up. After the last decrease and after every rate change, clients always call us and ask, what's happening with my rate? After the last rate went down by 0.5%, they think that their rate must have changed too. In this video, I want to explain how this works, what fixed rates are based on, and what variable rates are based on. After the last rate went down by 0.5%, assume that my rate has changed too. In this video, I want to explain how it works, what closed interest rates are based on, what floating interest rates are based on. I will also explain what the interest rates are on the market today, and what I recommend, closed or floating interest rates. So, I recommend you watch this video until the end, so you can become experts in this field and have informed conversations with your friends and acquaintances. So, let's not waste any time and move on to the presentation to discuss this important topic. Now, let's discuss these two options. There are variable and fixed rates. There is a bit of a mixed rate, but we won't be discussing that today. First, we'll talk about variable rates. To understand how the variable rate works, you need to understand how the Canadian Central Bank operates. The Canadian Central Bank has meetings. If you look at, for example, the year 2024, you see January, March, April, and so on. That's the rate they set. In June 2024, there was the first decrease of 0.25%. Then in July, September, and October, the interest rate dropped by 0.5%. As of today, the interest rate of the Canadian Central Bank is 3.75%. The next meeting will be on December 11th. It will be on December 11th. And after that, next year, you'll see December 29th, March 12th, and so on. Every time the Canadian Central Bank announces changes to the rates, it directly affects the variable rate. But the question arises, who is this 3.75% important for, and who relies on it? To put it simply, this is the rate at which banks lend to each other, which is why it's called the overnight rate. When one bank lends money to another bank, they do it at a rate set by the Canadian Central Bank, which is 3.75%. I'm saying this in simple terms, so it's easy to understand. They lend at the rate set by the Canadian Central Bank, which is 3.75%, when it comes to the rates they offer to clients. Of course, the bank wants to make a profit from that. And this isn't some short-term that changes every day, like the overnight rate. This is the rate that the bank guarantees to the client for the next year, 2, 3, 4, 5, and so on. This is what's called the prime rate. Banks add a certain amount on top of the Canadian Central overnight rate. That's their profit. So, the difference between 3.75 and 5.95 is the theoretical profit that banks make when they offer mortgages to clients. And these rates are the basis for loans related to lines of credit and credit cards. Of course, there's a huge difference in the rates, but in the end, they all stem from the prime rate. For example, if it's a loan that isn't tied to homes, it might be prime plus, like prime plus 3. Of course, there's a huge difference in the rates, but in the end, they all stem from the prime rate. If it's, for example, a loan that isn't tied to homes, it will be prime plus, like prime plus 3. So you take 5.95, add 3%, and you know what your rate will be. And in doing so, the bank regulates or controls its risk. The less risk there is, the more the bank is willing to offer you a good rate. The higher the risk, the worse the rate becomes. So, when we talk about credit cards, it's prime plus 20, which is the least favorable credit. Because the highest risk loan for a bank is credit cards. But banks also offer discounts. They offer clients a rate that's lower than the prime rate. Especially when it comes to mortgages, we usually tell the client that we can offer them a rate of prime minus 1. If the rate today is 5.95, we can offer the client a rate of 4.95. Why are banks willing to offer discounts? There are many reasons for this. First of all, it's a mortgage, so they have something to hold on to. If you stop paying, they'll just take your house. Secondly, by doing this, they attract or retain the client. That's why banks are willing to offer discounts. And this discount, of course, varies a lot between banks and depends on the type of mortgage you choose. The calmer it is. For the bank, the more favorable it is. For the bank, the better discount they'll offer you. For example, if you put down less than 20% of your equity, your mortgage is insured. And then the bank says, I have nothing to worry about. If something goes wrong, we'll take the house, we'll get our money back, and if we didn't make enough from it, the government insurance will compensate us after the sale. So, when we talk to the client, they say they would like a floating rate. We say, okay, how much of your own capital are you putting in? Because that affects the final outcome. If you put down 20% or more of your capital, then the rate will be worse and the discount will be smaller. Why? Because for a bank, the highest risk is when they do not have government insurance behind them to protect them. So often clients are surprised and say, how can this be? I'm putting in 20% and I got, for example, prime minus 0.5%. My friends were with you yesterday and got prime minus 1 and they only put in 5%. I'm putting in 20% and I got, for example, prime minus 0.5%. My friends were with you yesterday and got prime minus 1 and they only put in 5%. That's why they got a better deal. Why? Because the bank's risk is lower. When there's a government insurance company backing that mortgage, which protects them. This is a very important point when we talk to a client and discuss why one client gets a better discount while another gets a worse one. And now let's talk about fixed rates. Fixed rate mortgages. The thing is, a fixed rate doesn't have a direct connection to the Canadian Central Bank. Many clients think that if the interest rate changes, then my fixed rate has changed too. No, the thing is, I can't say that a fixed rate has nothing to do with the Canadian Central Bank. Of course it does, but it doesn't have a direct connection. And usually they are a bit ahead of the game. They know where the Canadian Central Bank is headed. And the reason they know is that they understand it depends on interest rates, inflation, and the economic situation. So they react in advance to the situation. Rising or falling interest rates from the Canadian Central Bank. And when that happens, whether the interest rate goes down or up, they get, let's say, confirmation that what they thought actually happened. But the so-called bond market plays a huge role. The bond market plays a huge role. That's what fixed rates are based on. I would like to show you something right now. Please note that the last interest rate cut by the Canadian Central Bank was on October 23rd. On October 23rd, the rate for 5 years was at approximately 3.02. And please note that the Canadian Central Bank carefully lowered the interest rate by 1%. Instead of bond rates going down, they went up. So, when clients called us and asked this question, we said, you know what? Be happy that you have a fixed rate, that we locked it in before you moved into the house, or that we gave you a pre-approval for 3 or 4 months. I often advise clients, if you're planning to buy a house, reach out to us, we'll get you a pre-approval, we'll lock in your rate, and if it goes up, don't have to worry. It will go down, you'll get a better deal anyway. It doesn't cost anything. The bank pays us anyway, not you, whether we're doing a mortgage or not. So, I always recommend getting a pre-approval to lock in that rate. But for me, this point was really important. I specifically wanted to show that on the day the central bank lowered the interest rate, bond rates went up, and note that from October 23rd until today, there have been no changes in the Canadian Central Bank. But look at what bond trade is doing. And that's what the rates are based on. So if you want to know where the fixed rate is, or which way it's going, you can go online, type in this 5-year bond trade, and you'll see what's happening with it. For example, every day when I'm expecting what will happen with the rates because our banks change the rates every day. They're going down, they're going up. I'm looking at the bond rate. If I see that the rate has gone down, then I know that the banks will probably start bombarding us with emails saying that our rate has improved, the rate has improved. If the bond rate goes up, then we're likely to get an email saying, if you have clients, let's urgently send us the deal today, because tomorrow, rate will go up. This is a very important factor for you to understand what the fixed rate is based on. So, I think, after seeing this, if the Canadian Central Bank changes the rate, and you have a fixed rate, you know that most likely it either hasn't changed, won't change, or it will change, depending on whether your rate is fixed and for how many years, whether the rate has gone down or up. Your situation will be based on that, but there's no direct connection between the Bank of Canada rate and fixed rates. And now let's discuss the difference between a fixed rate and a variable rate. I explained what the fixed rate is based on and what the variable rate is based on. But how do they differ? It's, of course, the difference in the option itself. If you go for a variable rate, then of course your risk increases. It's risk or reward, depending on which way the rate is going. So, when a client asks me, Victor, what would you recommend, a fixed rate or a variable rate? I always say it depends on the situation. I've always loved and supported fixed rates. At the end, I'll share my recommendation. If you choose a variable rate, it depends on your nerves. If you can sleep peacefully, go for it. If you dislike risk, choose a fixed rate for peace of mind. A variable rate can change. If you don't like risk at all, then it's better to go with a fixed rate and sleep soundly. Because the variable rate can definitely change. That's what sets it apart from a fixed rate. Sometimes the variable rate is higher than the fixed rate. There are situations when it's lower. Usually it's lower, but today it's higher. So there's not much motivation coming from the interest rates. But at the end of this video, I'll explain why I recommend one option or the other. The second thing, of course, is the difference. If you have a fixed rate, you know for sure that for 5 years or 3 years, depending on how long you've locked in your mortgage, nothing will change. The monthly payment stays the same, with no changes. But if you have a variable rate, there's one difference. I advise you to pay attention to what I'm about to say. There are banks that, when the interest rate changes, if you have a variable rate, they don't change your monthly payment. It stays the same. This means that if the interest rate goes up, the amount that goes towards paying off the loan just decreases because the monthly payment doesn't change. The interest goes up, so something has to give, and that's what gets reduced. The amount that goes towards paying off the loan, and of course the mortgage stretches from 25 years to 30 years, 35, and even 40. What happened in the last few years is that people took a variable rate and they had that variable rate with a fixed rate option. This means that their monthly payment didn't change. Many people didn't even pay attention to this until one fine day, the bank called and said, "Look dear, you had a variable rate. The rate is going up." And you probably didn't even notice, but it's so high now that your monthly payment doesn't even cover the interest anymore. So we're raising your payment, and we're raising it by enough to get back to the original amortization, because based on today's amortization, your mortgage that was supposed to be 25 years is now set for 50 years. And that's when people experience that payment shock, when their monthly payment went up significantly. I am completely against these options. Banks like TD offer that kind of option. I believe that the interest rate should change, and your monthly payment should always change when the rate changes. Yes, it can be unpleasant when the interest rate goes up, but at least you know what's happening. That's why I prefer the option, where if the monthly interest rate changes, your monthly payment automatically changes too, and your amortization stays as it should be. If it was 25 years, then you have 25 years left. Now, I would say the most important point from this whole video: the difference between a variable and a closed rate is the penalties for breaking the deal. When interest rates were very low, the penalty was not that important. There, for example, no one was running away. They were with a bank and were happy with the rate, so the penalty wasn't that important. When interest rates went up, for those people with a closed rate, the penalty also wasn't that significant because, of course, they weren't planning to break their mortgage with a good rate to get a mortgage with a higher rate, but now we're at a point where interest rates are high. When interest rates went up, for those people with a closed rate, the penalty wasn't that important either because, of course, they weren't planning to break their mortgage with a good rate to get a mortgage with a higher rate. But right now, we're at a point where interest rates are high, and they have a tendency, of course, for the rates to go down, and you'll have a huge motivation to change that rate. And here comes the question: what kind of closed rates do you have? Do you have closed rates at banks with small penalties or banks with big penalties? So, if you have a closed rate and you're with RBC, TD, or Scotia, the chance of getting out of that deal and getting a better rate in the future doesn't exist because the penalties are astronomical. We're talking about penalties, and they're not small, they're huge, 2, 3, 4 times. So I recommend you watch this video that's now showing on my screen. I recommend paying attention to the option. I always say this: the interest rate is important. It's my job to find you a good rate. But the conditions are much more important, especially now when we expect rates to go down. And you know, there's another important point. But the conditions are much more important, especially now when we expect rates to go down. And you know, there's another important point. Statistics show that 60% of mortgages don't make it to the 5th year. People break their mortgages for different reasons. Divorce is like death, changing jobs, or something else. But in the coming years, there will be motivation to change the rate precisely because the rates are going down. So if you took out a mortgage with one of those banks that have high penalties, you have no chance. You'll just be angry at yourself and kicking yourself, but you won't be able to change anything. So I recommend you reach out to us. We'll get you a fixed rate. The interest rate itself will be good, but what's even more important is that the terms will be good. And we are interested in helping you move forward. If the rate goes down, we'll call you and explain why it's beneficial for you. For example, you might lose $5,000 for losing a deal, but in the next 3 years, you could win, $15,000. And then, of course, people have motivation. Another point is also very important. When we talk about variable rates, the penalties can end up being the same everywhere. Whether it's RBC, TD, or Scotia, they're all the same. At some point, you'll want to switch to a fixed rate. It's a normal occurrence. When the fixed rate becomes really interesting, you'll want to switch to a fixed rate. And at the moment when you want to switch to a fixed rate, you can only do it with the banks you're currently with. For example, you took a fixed rate with RBC and you want to switch to another fixed rate. You can switch for free. No penalties, nothing at all. Just switch to a fixed rate. And at that moment, you find yourself in the same trap again, where for the next 3 or 5 years you can't do anything. So I advise against getting a variable rate from banks. Instead, go with the right bank right away. That way, if the rate ever goes down or up and you want to switch to a fixed rate, we can do that within the same bank and you'll get the right option, one with low penalties. This is a very, very important factor. So I'll say it again. Watch this video where I explain how the math works with penalties, and then you'll understand why it's important for me that you not only get a good rate, but even more importantly, good terms. In conclusion, I'd like to say that both variable and fixed rates ultimately depend on the economy. We're also very dependent on the Americans, so I recommend you watch the video that's on your screen right now. I recorded it after the elections, discussing how the elections in America could affect our interest rates and real estate prices. I recommend you watch it. I think you'll find it interesting. When it comes to fixed rates, you can definitely sleep easy. But now, for the first time, I'm telling clients, it might not be a bad idea to play around with a variable rate because we're expecting that the fixed rate might drop by 3.5% next year. But now, for the first time, I'm telling clients, it might not be a bad idea to play around with a variable rate because we expect that the fixed rate drop by 3.5% next year. The variable rate will drop very quickly because it depends on the economic situation. Our economy is in a very poor state. We're probably going to have issues with the unemployment rate. But when interest rates go down, home prices usually go up. But I don't think there will be any big increases because our economic situation is quite complicated. But anyway, someday, because I know that a huge number of people are waiting for that moment when interest rates go down further and real estate prices drop. But someday we'll reach a point where interest rates go down and real estate prices go up. Here, I definitely recommend you reach out to your realtor. I hope you're working with the right realtor who understands the market. If you need a good one, call us and we'll recommend a realtor. But it's a very important factor, of course, to make the right decision in time. So what do I advise you? I advise you to reach out to us for all these questions. We'll explain to you exactly which option is better today, whether it's a variable or fixed rate. We'll do it at the right bank. I've been working in this field for over 22 years. In my province, I'm in first place. We work all over the country. We offer both insurance and mortgages, as well as home insurance. Any options, I always tell my clients, for any reason, you can reach out to us. And that's why I advise you to reach out to us. We'll answer all your questions, find the right option for you, with good rates, and you'll be 100% satisfied. Because our goal is for you to be happy and recommend us to your friends and acquaintances. That's all for today. I wish you all good mood, health, and blessings. Until next time in the virtual world. This was Victor Sheffer.
Thank you for watching this video. We hope you found it helpful. We'd be happy if you share it with your friends and acquaintances.
Follow us on Facebook at VS Financial Group and on YouTube at VS Solutions.
If you're interested in getting a mortgage or you need insurance, fill out the form on our website, vestsolutions.ca.
Contact us 1-800-772-820904, safe@vestsolutions.ca. Enjoy today. We'll create success tomorrow.
Or write to us at save@www.vestsolutions.se. Enjoy life today, and we'll create a successful tomorrow for you.